look at, if there was ever any hope that the banking inquiry was actually about discovery of what happened, today was the day when that ended and the general election campaign began, and that discovery went out the window.
Cormac, do you have any views on this?
Well, today, I suppose, wasn't really about the banking inquiry. It was a lot about electioneering. But 2 days ago, Fergus Murphy was on. He was from the Educational Building Society, and he revealed quite a lot. He said that his society could have survived if they didn't get into property speculation. He also said when he took over in 2008 that the bank had a huge amount of bad loans, or troubled loans, but then he said that he thought that the EBS was solvent on the 30th of September. And this issue
of
2008. Now, I don't think he has any
the day
evidence.
Of the bank guarantee.
Yeah, I don't think he has any evidence to support that. He might say, well, the published accounts say they're solvent, but that doesn't mean anything in real life. And this debate about solvency and liquidity has dominated the banking inquiry, and I still don't think they've got an answer to it after a few months of the inquiry. In fact, after 7 years, the question everyone is asking, or should be asking, is on the 30th September 2008, were the Irish banks solvent? And the answer, the evidence has come across gradually, but the answer has to be at this stage definitely not. There's no way they could be solvent. Now, the reason I say that is that it was well known that many of the Irish banks were lending recklessly. And if they are not calculating the value of their assets, or not calculating the amount of losses they've suffered, no one is going to lend to an Irish bank. And for that reason alone, the Irish banks do become insolvent because they have to sell assets in a quick-fire sale. So these are the questions that the bank inquiry has been checking, or rather asking, for the last couple of months, but I don't think anyone on the committee has got an answer yet. If you ask anyone on the committee, do you think the banks were solvent, the best they can say is, we don't know. What the bankers and the politicians and the accountants have said is there was no evidence that they were insolvent. And the reason that there was no evidence is because they never bothered measuring it.
But wasn't there a difficulty then? And the difficulty was that to determine whether banks were solvent or not, you had to have an idea, had to have some idea of to what extent was there going to be a property price reduction. And that a lot of people at the time, nobody at the time, I think, bar maybe Morgan Kelly and UCD, thought that there was going to be a 50% collapse of the property prices. People were talking about a 20% collapse. And a lot of the bank could have survived a 20% collapse.
Well, yeah, it's an interesting point, but I don't think we need to try and gaze into a crystal ball as to which way property is going to go when you're deciding whether a bank is solvent or insolvent. An interesting statistic from Bank of Ireland is that rental income fell by a maximum 20% over the period, not 50%, from about 2005 from about 2008 to now. It fell by 20% only for a brief period. Now, it follows, therefore, that none of the banks should have collapsed because a 20% fall isn't that much. The reason why banks collapsed is they ignored the rental income. They just said property prices are going up, and therefore we'll take a punt on it. If we get it right, we'll make a huge amount of money. If we get it wrong, we suffer. Now, so that's what they were doing from September 2005 onwards. They were speculating on property. Now, obviously, it has to go wrong at some stage, particularly if rental income isn't growing to the same extent that property prices are growing. So, therefore, you shouldn't look at property prices to determine whether banks are solvent or not. What you should look at is their lending policy, and the fact that they have relaxed their lending policy, and the fact that they have lent recklessly without bothering to measure the losses that they've suffered. That's how you determine if a bank
But how were they to know that in 2007, for instance? How were they to know that they were lending recklessly?
Okay, well, it does get a little bit technical, but back in 2005, most banks operated what's known as a statement of recommended practice. Now, I'll explain that in very simple terms. You might be a bank and you might offer mortgages, and you might say we have a policy of asking for 10% upfront and then paying 3.5 times the salary as a loan. Now, if you go outside that range, you can still do it, it's not illegal, but the bank must record a loss. So, for instance, if I give you a loan of 600,000 based on your salary, and then I decide, well, I'm going to up it to 750,000, then the bank must split the loan down between what they expect you to pay back and the extra 150,000. Now, this is known as a statement of recommended practice, and back in 2000, all banks followed that. And they also got guidance from a crowd called the Financial Reporting Council in the UK, who basically set the accounting standards. They say, although these are not law, if you stop following them, you must tell shareholders that you stop following them. Now, all the Irish banks did stop following them, and it meant that when they lent recklessly, they didn't have to recognise the losses. And they didn't bother measuring the losses. So that's how you determine.
They didn't tell the market. They didn't tell people who were investing in the bank.
Well, they didn't. It's an interesting point because the Financial Reporting Council did a huge U-turn. They said if you're not going to follow these statements of recommended practice, you must tell the shareholder. But then they issued guidance that because of the new reporting standards which the European Union imposed on Ireland, you can ignore these statements of recommended practice and you don't have to tell the shareholder. Now that's completely wrong, and Allied Irish Bank got into trouble with the US government when they filed their accounting returns to the US because they were listed in the US. This would have been around 2007.
Anglo-Irish Bank got into trouble?
Sorry, not Anglo-Irish Bank, Allied Irish Bank.
Why don't you call it?
No, I won't say get into trouble, but they were asked to explain whether the accounting policy has changed, and they said that they have stopped using this statement of recommended practice, but they received an assurance from the Financial Reporting Council that they did not have to tell shareholders of this change. And that's quite a serious point because it does suggest that there was a deliberate intention to change the accounting rules without telling anyone. So to go back to your question, that's how you do measure solvency. You measure the normal loans from those loans which are reckless, and you can distinguish them with the statement of recommended practice. What has happened since 2005 is that the banks merged these two together, so they no longer could tell which loan was reckless and which loan wasn't.
And I have been able to follow the banking quite closely because of the other project I'm involved in. But I don't recall this is coming up at all in the banking.
Oh, it did, yeah. PwC were in
Ian Walsh was in from ECB.
Well, they brought up the accounting queries, but both PwC and Eamon Walsh said that what they were doing was legal. Now, they did say there was a problem in the accounting, but they said what they were doing was legal.
Nobody's suggesting anything illegal was done.
Well, I'm suggesting
it was like
there's a thing called fraudulent accounting.
The rules were completely inadequate to the situation.
I think
Nyberg found that it was the terrain essentially within the very narrow scope that they were supposed to be auditing, that they were complying. But that the problem was the mechanism. The problem was the expectation.
That's what they're trying to get across. But I can't believe.
In America, the banks were subject to a stricter regime, isn't that right?
The auditors
what has happened is that this model, known as the incurred loss model, allows you to delay telling shareholders about losses you've suffered, and that was copied from America. Now, America realised that they got it badly wrong, and they have changed it back to the original accounting, whereby if you make a loss, you must tell the shareholder immediately. Here in Europe, they say, no, we're going to stick with this process.
But surely that's because so much of our policy is now being dictated from above.
Well, it's complicated. Obviously, prior to 2000, the accounting was fine. If you had a loss, you told everyone about it. Then the European Union came in with rules which were implemented in 2004, and they said, under these rules, that you can hide losses. Now, there's a problem with the legality there, because when these rules came in, they're called the International Financial Reporting Standards. These rules only dictate what goes into the published accounts. They don't affect what are known as books of account. If you are a company, you must keep books of account, because if you become insolvent, you have to stop borrowing or raising money from shareholders at that point. Now, what has happened is that in the books of accounts, you must calculate losses. You could argue that you don't have to do it in the published accounts, although I disagree with that argument, but in the books of account, it's 100% certain that you must reveal your losses. The problem from a legal perspective that the Irish auditors face is that they have said that the books of account are in agreement with the published accounts, and that statement cannot be true, because with the books of account you must reveal all losses. There's case law on it, it's a mandatory case. What they say is that, or what that case said is that the assets must be valued correctly, so that the financial position can be determined with reasonable accuracy.
So this is why I think that it isn't just illegal what they did, it's criminal. There's a crime called fraudulent accounting. And to misrepresent the state of a company and to do so deliberately, thereby encouraging people who want to invest in that company to put their money into what is a a broken company is a fraud.
Well, it's very interesting
And a crime.
if you
It's
look at the
similar to
contrast
robbery,
between how Ernst & Young have been treated here in Ireland, who audited Anglo, and how they were treated in the United States when they audited Lehman Brothers, because they were fined. In 2007, they audited Lehman Brothers and they collected $31 million in fees from them. And in 2010, they were charged with massive accounting fraud by the state of New York and paid $99 million in fines. Now, we know that $99 million is probably a drop in the ocean if they're getting $31 million a year for one company, but nevertheless, it does make a statement, and it's a statement which hasn't been made in this context. It's a powerful statement, and it raises, and I think in fairness, Vincent, this is, for me, one of the weaknesses of the banking inquiry when you compare it, for instance, to some of the investigations that have happened under the PAC in the UK, where they've looked in particular at the role of the Big Four. Because we've had a lot of talk in the banking inquiry about the Galway tent and about intimacy between politicians and developers. We've had very little really fine-grained, thorough investigation of intimacy in accountancy and auditing. And it's a very significant issue. It's coming up again now around the IBRC issue, but it's a looming boil in terms of the banking
I think if the banking inquiry